Good afternoon, everyone. My name is Baldev, Bhinder, and welcome to our webinar on security documentation dealing with trade finance. I'm giving this webinar from my office in Singapore. This is probably one of the last places in the world now where we are allowed to go to our offices. I wish everyone is safe and well. And in the comforts of your home, I'm hoping to give a bit of insight and perhaps a bit of an education on trade finance, security documentation, and double financing. Let's get on with our seminar right now. Now, every year, we tend to see a collapse in the commodities trading market. The story tends to be the same. It tends to be a large trading house, over-leveraged, borrowing from many different banks, and subsequently, at one point or the other, without adequate warning, or without any warning, the company collapses and moves into a restructuring or liquidation. Sometimes, in this process, what we find in the aftermath is that we find that there's a heavy amount of double financing, multiple financing. We find lenders in particular trying to get access to their security that's been pledged to them and find that they're holding on to documents while their goods have long gone. How has this situation happened? And today's exercise really is to sort of gather all the actual cases we have worked on to share some key examples of how to prevent trade fraud from happening. Let me start by saying this. There are three traits to international trade, modern day international trade, that gives rise or that facilitates what lenders fear the most, where they are unable to get paid. And these three traits are: number one, liquidity. Now, the modern international trading world is no longer about no longer about physical arbitrage opportunities between country to country. Everyone seems to know what the pricing is between country to country, and so the real opportunity, the real ability to make money is really on extending credit terms. That is really what the trading business has come about to in this modern day. What does that mean? It means that traders are going about offering 60, 90, 120-day credit terms. And these credit terms are the ones that make it attractive. And one trader will offer numerous credit terms to other traders will build on that, and what you get from that cycle is a bit of a house of cards. And when one card gets pulled out, that's when the house topples. The race to get liquidity has impacted everyone. Traders go to every possible source to get liquidity. They go to other traders in the form of prepayments or in the form of longer credit terms. They go to banks. They go to alternate lenders. They go to factoring companies, and even crowdsourcing companies. There is no end to where financing can be obtained. It is a race. All traders are racing to get financing. But the point I raise is this: it's not a race to the top, it's a race to the bottom. Number two deals with obscurity. Now, international trade, unfortunately, still works in a very archaic manner. You have security coming in the form of paper. Goods and the paper documents don't move at the same time. So physical goods that move from country to country, and the security documentation and title documentation that moves with it moves at different speeds and at different times, passing through different hands. So with this obscurity, as a lender, you can't really tell where your security, where your goods really are. You're holding on to a bill of lading, you're holding on to a warehouse receipt, but do you really have visibility over where the goods are? More importantly, you're lending money for trade finance, but are you sure that that money is being used for that particular trade? Or is it being applied to a more risky investment, for example? Because the point of using funds for more risky investments feeds back to point number one: liquidity. Everyone is in a chase to create and to pursue liquidity. And that means taking your cheaper financing, be it in Singapore, Hong Kong, or Geneva, and apply it to more risky ventures in other parts of the world. There's a fragmented chain in the international supply chain of goods. Goods pass from seller to buyer to another buyer to third buyer to fourth buyer. Each one sat in a different country, each one with different operations, each one not knowing who their original supplier is. Each party just deals with its intermediate and immediate party and not anybody else. Between these chains are fragmented gaps of information. Most importantly, it's this. Unscrupulous trader, he knows that two banks wouldn't talk to each other. He knows that Bank A and Bank B don't really talk to each other in terms of what security is provided, what leveraging has been given. And that's because of banking secrecy laws. I mean, ultimately, we might have to look at the benefit of banking secrecy laws and what intention it's meant to protect, and weigh up against all the abuse that has been happening in the world. Number three, in terms of traits that I want to raise, would be this. Trade finance, in particular, the use of bills of lading, is still predicated on a very archaic manner of trading. It involves paper documents, bills of lading, which effectively give title to the goods. And the obsession then is on the title documents itself, on the bill of ladings, and not much attention is paid on the goods. So everyone, it's a bit of a magic show, right? You're looking at the title documents the whole time, but you're not really looking at where the goods are. And it's in this world, this murky world of trade finance, I mean, this murky world of documentation, that the documentation and the goods might not line up at the same time or at the same place. I want you to bear in mind these 3 points, because these are 3 reoccurring themes throughout the slides and throughout the presentation. And I would like you to bear these 3 points in mind as well each time there is a transaction before you, because understanding the mentality is key. A trader's mentality boils down to getting as much monetization as possible. They would monetize every document, every day, every transaction if possible. And it's this mentality that gives rise to taking on a huge risk. Ultimately, in all the cases we have worked for, a large part of them have gone into restructuring. And effectively, the lenders are taking a haircut and getting maybe 10% of what is owed to them. Now, if you are the trader's position, if you are an unscrupulous trader, that's really what's playing on your mind. You are thinking to yourself, let's borrow as much money as possible, so that, and my bottom line would be, in the worst possible case, I'll pay 10%. It's this mentality, I think, that creates some of the structures that we'll speak about in this webinar. Let's start with an overview of how security documentation is done in trade finance. What we have, let me say this about security documentation. It's understanding security documentation is a very technical subject. It can bore even the most diligent of lawyers, so don't feel afraid that you're looking in this and being confused or being put off by it. I'm giving you an overview of the different types of security that is in play when doing trade finance. And I've tried my best to actually use normal language instead of legal language. We call receivables, for example, we call them choses in action in law. And sometimes I feel we use this language so that nobody else can understand what we're talking about apart from the lawyers. It's a bit of a self-interested sort of mechanism. But back to the topic at hand. What you have before you in front of your screens would be the types of security documentation in play. On the top right of your document are the 4 types of securities that are typically given in a trade finance: mortgage, charges, pledges, and assignments. On the left, you would notice fairly familiar terms if you're in this business. These are not security per se, but they're known as quasi-security. They involve things like retention of title clauses, which are put into contracts, a negative pledge or negative covenant, whereby a borrower promises not to encumber his assets or his asset that has been pledged. Factoring, which is, broadly speaking, I know a lot of people in the factoring business would call me out on this, but broadly speaking, invoice purchasing and receivable purchasing. And the last form of quasi-security would be setting off debts owed in between two parties. At the bottom of the screen, I've gone on to deal with the actual asset-specific nature of security. You've got physical assets, which could be goods in a warehouse, could be goods on a ship. You've got receivables, which are effectively your book debts. They are amounts that are payable to you guys. You've got bank accounts, and bank accounts, the factors to consider with that would be things like control. And you've got share pledges of holding companies, of your borrowing companies, of anyone that's taking on a loan effectively. These are technical terms, but I'm going to focus on three of these terms in the slide: charges, pledges, and negative covenants. Now, why am I focusing on charges and pledges in particular? It's because, let's start with this. In a typical trade finance structure, you have fixed and floating charges that are given out, that are secured in favor of the lender, and then you have pledges. Pledges are very typically found with bills of lading and with warehouse receipts, where a document is pledged to the lender in return for drawing down on certain funds. You have negative covenants, which I spoke about before, which is something you find common in loan documents, whereby a borrower promises not to encumber his assets any further. I want to make 4 points about security, and I want you to remember these 4 points as well. Number one is possession. Possession is actually a critical factor in terms of what type of security or how good a security you have. Now, possession, you have actual possession, which is how pledges have typically come about. You give someone the shares to your company, you give them the keys, perhaps, you give them the actual asset, saying, I'm pledging these goods, be it copper, be it agri, be it oil, to you. You keep the goods physically so that I can borrow money. In trade finance, however, it doesn't work that way, because banks naturally don't really want to have physical possession of goods. So what they have is something known as constructive possession. And I will come to that subsequently. Now, if we go on, the second point I want to speak about is control. Control is important because there is a fixation over using fixed and floating charges in loan documentation. Now, if a fixed charge is given over a particular bank account, or let's say a particular set of goods, then there isn't a question to be asked about control. You can't have a fixed charge if you don't have control over it. So as far as lenders are allowing borrowers to move goods in and out of their premises, to allow funds to come in and out of their bank accounts without checking with the lenders, that effectively means that your fixed charge is more theoretical than it is practical. Because what that means is that you probably don't have a fixed charge. To make it more simpler, you probably wouldn't have a fixed charge, and what you would have really is a floating charge. And what is the difference between fixed and floating charges? Well, when it comes to insolvency, a fixed charge ranks higher than a floating charge. And floating charges would be, you'd find yourself queuing up with a large amount of other creditors. Number three, when it comes to security documentation, the number three consideration to think about would be enforcement. How easy is it for you to enforce the security document? Yes, it's very great. It's very good to have a pledge of cashew nuts in Vietnam. But how easy is it for you to go as a lender or as a counterpart to go into a warehouse in Vietnam and take possession of those goods? The warehouse operator will say, I don't know who you are. More importantly, I think he'd say, I don't need to listen to you. If I only need to listen to the courts of Vietnam. So then you'll have to go to the courts of Vietnam and get a court order. How long is that process going to take? Will your goods still be there once you're done with that process? So enforcement requires thinking through the situation, both in terms of how the jurisdiction of the country is, where the assets are, It also requires you thinking through steps such as condition precedents towards the enforcement. Let's take shares, for example. I've pledged shares to you. Everyone knows that if you want to pledge shares, according to most companies, you will need to get shareholder resolution, board director resolutions. All of that should be pre-signed so that when enforcement comes, you can then effectively enforce it without having to go back and then jump through some hoops to get your enforcement through. The point about enforcement that's linked to negative covenants would be a lot of banks, a lot of lenders take comfort in their documentation with language that has a negative covenant, i.e., if the borrower was to encumber assets that already have been pledged, that would effectively mean an event of default, which a bank can call upon. Now, the difficulty with this is that what we find, from experience at least, is that charges tend to be registered on APRA, and so everyone gets to see a charge is registered. That effectively creates what we call in law constructive knowledge. It doesn't mean actual knowledge. It means you are taken to have known that actually the negative charge was being breached. And by not doing anything for 1 month, for 1 year, while charge after charge after charge is being registered on a company's registry, I think in law what happens is that you will be taken to have said to have waived that negative covenant. So that negative covenant then becomes very cold comfort. The fourth point about security documentation would be to consider visibility. Visibility is at the heart of what has gone wrong with a large part of cases that we deal with. Visibility meaning who else would know that you have security over that particular asset or over that borrower. Now, we have to take a step back over here, and there is a bit of a disconnect between charges and pledges, and that's why I want to focus on the two. Now, charges, fixed or floating charges, are registered. The way to perfect a charge is to register the charge on APRA, on the Singapore Companies Registry. And so the world at large can see that there is a charge registered against the company. So if I was a new bank seeking to lend to a borrower, the first thing I would do, apart from checking the address of the borrower, I suppose, the first thing I would do would be to look at the APRA sheet to see what charges have been registered. Now, that's all good and proper for charges. And the reason why that's the case is because charges don't require possession. Charges are an intangible form of security where you don't really have possession. That's why the world needs to know that you have an encumbrance over the asset. Now with pledges, how a pledge is meant to work, if you recall what I mentioned a few minutes ago, a pledge is meant to work by giving physical possession of the goods. That's the standard idea of a pledge. But in modern day trade finance, we know that physical goods are not stored are not given to lenders. Physical goods instead are kept with the borrower, are kept with the trading parties, and what is given is a pledge. What is pledged? The title documents are pledged, or documentation is pledged. Bills of lading are pledged, warehouse receipts are pledged. Now this pledge effectively gives what is known as constructive possession to the lender. So the lender feels secure. The lender feels everything is great. I've got a pledge. If need be, I can go and get the goods. I can go and take title and get the goods physically there. Now the difficulty is this. Pledges are not visible to the world. No one knows that you have a pledge or a pledge has been given in favor of you. No one knows that apart from the lender and the borrower. This allows me, as an unscrupulous trader, for example, to give 10 pledges at the same time to 10 different banks. No one is going to know, or it's actually quite difficult for banks to know that I've given multiple pledges over the same set of goods. With warehouse receipts, pledges work, or this idea of constructive possession work through a process of attornment. Now, attornment is one of those legal terms that we once again have given to confuse everyone and to put people off. But attornment effectively means a third party, meaning a warehouse operator, has got the goods and he's saying, don't worry, lender. I'm writing to the lender as the warehouse operator saying, don't worry, I've got the goods. I'm returning to you. I'm recognizing your rights. That is how attornment works. And by recognizing your rights, by giving you such a document, the bank can be said to have taken constructive possession. Let's move on to the next slide. BLs. Why are BLs susceptible to abuse? I've touched on this briefly before, but let's go through these points because it's absolutely critical to remember the BL that you hold as a lender or as a counterpart and the comfort you get from it might be more illusory than it is real. Number one, BLs are physical paper documents. Physical paper documents that move physically, original documents that move through DHL, through FedEx, keeping them busy for a long time, from one part of the world to another. It is an extremely archaic form of documentation, and it still goes on 300-400 years from when it was first incepted. Secondly, would be the nature of two-order BLs. Two-order BLs effectively means creating a title document in favor of whoever holds the BL. That is where there is no named consignee on the BL, no named beneficiary of the BL. Third would be this practice of switch BLs, where as a supplier, I'm worried that my buyer shouldn't know who my original supplier is. So I then switch the BLs to effectively cover my name, to insert my name as supplier over the original supplier. Number four, high sea sales. High sea sales would involve the switching of BLs from one party to another while the goods are on the water. That is actually one of the key risk areas of trade finance, because no one can verify, no one can get visibility, no one can authenticate or legitimize trades between parties while goods are on the water. The last anyone can do really is to say person X put it on the goods at the load port, person Y took it off the goods at the discharge port. In between between X and Y could be 10 parties switching the BLs, rotating the BLs on the high seas. Number four would be the point of carrier. I want to jump quickly to the point of copy BLs. It frankly amazes me that copy BLs are still used in international trade. Now, I know what lenders would say, they only extend copy BLs or they only lend on copy BLs when they are lending to some of their most trusted borrowers, the biggest and the best names in the business. But one point I want to raise is this. Yes, you might be lending to the best companies, the most reputable companies in the world, but where have they gotten their BLs from? Now, unless they have originated the BLs themselves, they could very well easily be victims of a fraud themselves. And that's where we'll come to in one of the slides going in a minute, in terms of how big companies or large reputable MNCs are being used to deflect or otherwise to give a sense of legitimacy to an otherwise artificial or mirror trade. I've spoken about information gaps and numerous hands. The more hands a BL passes, the more likely there is a risk for fraud, more likely there is a risk for manipulation or for double financing. And the last point I want to get to would be house BLs and ocean BLs, where there is a distinction between the types of BLs that are being used. We'll move on to the next slide. And that's a trade finance structure that we have put on. Now, this document must be quite familiar to everyone looking at it. This is a typical trade finance structure where you've got trader buying from, let's say, a producer. The producer gives him BLs, the trader pays him. The trader uses funds from the bank to then pay the producer. In return for drawing down on funds, the banks ask the traders to enter into what is known as a trust receipt, whereby the trader pledges the BLs or the bank accounts to the bank. The bank accounts, meaning the collection accounts, to the bank, in that whatever money is received from the trade shall be given to the bank. And then the trader is, in theory, meant to sell it on to the buyer. Buyer is meant to pay the trader, and then the trader pays the bank. This is in an ideal world. Unfortunately, I think from experience, we've all learned, I suppose, that we don't live in an ideal world. Where it goes wrong is that the trader either misapplies the funds he's received from the buyer, he perhaps doesn't receive any funds at all, he perhaps discharges the goods with somebody else, or he pledges the BLs to another party or another bank to get financing. So at the bottom of the slide, you'll see a trader creating effectively a phantom trade where he's pledging the security a second time to another bank or perhaps to another trader. Now, where does this leave us with recourse for the bank? What can the bank do? The bank hasn't been paid. It wants to go after, it wants to trigger its security. And so it then goes, and we have this many times as well, where the bank would call me and say, I've got the BLs, how do I know the goods are at the port? And I generally say, I think if you're asking me, that means that the goods are long gone. And that's the problem. Goods are long gone. Banks are holding on to paper documents, security documents that are either forged or not effective because the goods are no longer there. What is the bank's recourse then? Well, the banks can try to trace the goods by function of the trust receipt, can try to trace the goods to the buyer. But the problem is this: if the buyer has bought the goods or has taken the goods with no notice of this double financing by the trader or by this pledge by the trader, the buyer is known as a bona fide purchaser. He gets the goods good. His hands are clean. So then the right of tracing is of no use to the bank. The secondary option is for the bank to then go after the trader. And we've seen this many times in the past, that when this situation arises, it's a bit too late and the trader is no longer good for money. Now, the solution for this structure really would be what I spoke about in terms of visibility. How do you make visible to the world at large that there is a pledge in play? And my suggestion would be this: it would be that, like charges, maybe pledges should also be registered or registerable on ACRA or on companies' registry, so that anyone can see that there is an encumbrance being created for a company. Now, that's for the decision of the authorities in all parts of the world. But if one day people do it, I think you should say it came from me first. The second solution would be that banks or lenders should consider trying to minimize opportunities for a trader to physically hold on to the bill. So a producer, when he gets a bill from a ship, he perhaps should give that bill direct to the bank. Better still, the carrier, the ship, gives the BL direct to the bank itself. So you're avoiding as many hands from touching the BLs. Because the more hands are involved in touching the BLs, the more problems you'd have. So we're trying to track the history of the BL and try to minimize its use in between. Let's move on to the next slide. I want to touch about the movement of the BL, and here I'm going to speak to a few issues. Now, this is the simplest form of a trade finance structure I could think of. Seller sells goods to the buyer. Seller then physically has to incur the logistics of moving the goods. So he goes to a freight forwarder. He goes to the freight forwarder, gives him the goods. In return, freight forwarder gives him house BLs. These are BLs issued by the freight forwarder. The freight forwarder, for example, aggregates a few sets of goods or a few containers and then contracts with the carrier, the ship, the ocean liner. And in return, the freight forwarder gets an ocean BL. Now, I've raised the question over there on the slide as to whether a house BL and an ocean BL, which one is a title document, which one is just mere receipt. A lot of commentaries would actually say that house BLs can never be title documents, and I don't necessarily agree with that view. I think it's a matter of construction. When you look at that document, is it intending to give title to the person receiving that document? Or is it intending to just be a mere receipt, a mere acknowledgement that I've got the goods on your behalf? And one of the key considerations is to consider who is carrying on the role as carrier, which is the box in yellow. Who is the carrier in this transaction? Is it the shipping line or is it the freight forwarder? And I think looking at the document would give you an indication of this. So the first point to touch on would be the house BLs can be a title document. And if it can be a title document, then that creates additional risk as well, because the freight forwarder, there's a risk with the freight forwarder not being completely secure with the house BL. There could also be a risk of the freight forwarder releasing the ocean BL and the house BL to the seller. So now the seller has got two sets of BLs. And what do you think an unscrupulous seller is going to do with two sets of BLs? He's going to try to monetize it. Then there's an issue of switch BLs, which I've put at the left-hand corner of the slide. Now, the seller, while selling goods, as I mentioned before, might not want to, he might have sold it to a party in between him and his buyer. And so he wants to then protect the name of who the original supplier is. And that requires switching BLs. So the seller will contact the freight forwarder saying, hey, can you switch the name of the original supplier to my name or to somebody else's name? The freight forwarder might say, okay, no problem. And how it's meant to work, switch BLs are extremely risky, but how it's meant to work is that a party is meant to the freight forwarder is meant to be a one-for-one exchange. If I was to issue a new switch BL as a freight forwarder, I need to get back the old BL. Because if I don't, what we have then is another set of BLs. So now, in this situation, there are three possible sets of BLs floating around. The fourth point I want to touch on now is on the high sea sales element of it. High sea sales, as I mentioned before, are very common in trade, but also creates very problematic issues, which means that a trader would not be able to, a lender might not be able to verify who is the last owner of the goods. You see, goods are moving, hands are exchanged between hands numerous times while on the high sea. And who is actually the last owner of the goods. And that's why it's difficult to verify ownership of the goods. Last point I want to make about this slide is on the buyer side. So how it's meant to work, the buyer's meant then to present, he's got his house BLs in an ideal world, house BLs and only his house BLs, and he's meant to then present it to the freight forwarder. Freight forwarder is then meant to collect his goods using his own BL, the ocean BL. But what we find in our cases that we've worked on over the years is that, and this is very typical, that the goods are just, by the time the BLs are being presented, the goods are long gone. How can the goods be gone if the BLs are with the buyer or with the bank? How can that possibly be? It is possible because although extremely risky, it is common practice in most parts of the world to have discharge of goods by way of letter of indemnity. So a third party could show up to a discharge port and say, I want the goods, I am the correct beneficiary of the goods, I will give you a letter of indemnity to the shipping line saying, don't worry, I've got your back, give me the goods. If anything was to go wrong, you can come after me. And that's how a letter of indemnity is created. It is a big risk for a shipping line to take. It probably takes it only with reliable parties, but it still happens. It happens in ports all over the world. Moving on to the next slide, and this is where we get a bit of, if I haven't bored you already, we get a bit of diagrams now into our slides. And I want to talk about circular trades over here. And this is where we come back to that common theme of monetizing every possible position. In a 14-week voyage between seller A and buyer E, where a trade contract has been conducted, he's meant to sell, let's say, copper from Chile to China, and he's got a long voyage on that ship. In between, he's then meant to, the trader then thinks, let's try to monetize this 14-week voyage. I only need to give the BLs to the buyer when the ship arrives at the discharge port. So what should I do? And that's where circular trades are created. A then sells it to B, B then to C, C then to D. Each person in this circular trade, I know it sounds counterintuitive, each person then gets to A, access its own financing, B, revenue goes up on their books, everyone is happy, that musical chairs the music plays in these musical chairs, and everyone is happy. A effectively buys his goods back at a higher price. I know that sounds counterintuitive, but he's actually managed to access financing for different parties, and he's managed to get credit terms. So perhaps the wheel spins clockwise today, perhaps it spins anti-clockwise tomorrow. And that's how each party gets to benefit from the situation while goods are moving physically from one party to another. Now, traders tell me there's nothing wrong with it, but I find my biggest objection is that you can't have sold goods to E and then be selling again to B, C, D, and having a derivative trade of a physical trade. And that's why I use the term synthetic trade to it. It's actually, in my view, you're actually creating a financial trade of a physical mean trade. Now, it creates risk because you are creating artificial liquidity through this means. You have, for every $10 of goods, you are then creating $50 of revenue. And that's why international trade, I wouldn't be surprised, the stats say it's worth $4 trillion. I mean, the physical goods might just be 1 trillion, 1/4 of that, while the rest are actually just financial instruments benefiting from that. And this to me seems to be more like a financial instrument. Now, where is the problem with this? You create liquidity means that it creates additional risk in the system, whereby if liquidity is drawn out of the system, one party in this chain gets liquidity sucked out, the house of cards will topple. Another issue I have with this is credit insurance. Now, in this structure, in creating this structure, what is the credit insurer really insuring? Is he insuring the physical debt of E? What if the insurers are involved in B, C, and D? Can that be said to be physical? Can coverage be said to have extended? I think not. More importantly, I feel are disclosure issues. Should this be disclosed to an insurer? Would banks be taken to have known of this sort of types of trades? Would insurers be taken to have known of these types of trades? These are real problematic questions, and as far as I know, this hasn't been tested in the Singapore courts, neither in the English courts. No one has tested whether this sort of areas of this types of trade finance structures are covered by credit insurers and whether that should be disclosed under credit insurance. And the reason why I raise this as well is that it raises a more problematic theme that is alive in trade finance. And that is, we tend to see when we do trade finance investigations and so on, we tend to find, if we go back in time, what happens is that a borrower goes to find credit insurers, goes to obtain insurance first, a coverage of 10, 20 million, and then seeks to get financing. It is effectively the cart driving the horse rather than the other way around. And what you get, that's consistent with this theme that I'm raising of chasing liquidity. And when you chase liquidity, you're no longer thinking about the transaction, you're just thinking about creating liquidity the best way you can. This creates a problem because credit insurers can are only meant to do an assessment of the credit worthiness of the buyer. They are not privy to, they don't have the information to do with the transaction itself, the underlying transaction. That is the job of the bank that's actually lending the money to. And the bank and the credit insurers don't talk to each other. And the unscrupulous trader knows that. And that's where it falls between two stools. If I was to go on to the next slide, I want to talk about mirror trades and double financing. And this is a wild and wonderful structure. And it's not fiction. It has happened in a few cases over the years, and where a complete mirror trade is made using the same goods, same shipment, same time, but with different parties. And so on the left side, I've created a structure where an actual trade goes between A, B, C, and D, and that at the same time, an unscrupulous seller has then used a phantom trade has created a phantom trade by forging a new BL and passing it to E. E, F, and H then pass it on. no party seems to know any better rather than the fraudsters. And for this system to work, what must happen is that D and H must be in cahoots so that only one party comes to take the goods off the ship. If two parties show up at the port trying to take the goods off, that's where it's going to get unraveled. Now I know most lenders are sitting there thinking, this would never happen to me. I would never support this. There's no way. My borrowers, my counterparts are the best in the world. And I raise this because there is a trend towards creating a mirror trade. This doesn't happen overnight. And the trend is this. There will be a history of trades being done over the course of 1, 2, 3 years. The trades would be genuine. It wouldn't be genuine. It would be good. There would be no defaults. Everyone's happy with it. It's a bit like the circular trade we just mentioned earlier. As long as the music plays, everyone is happy. And then in between these sort of trades, what is created is that you put small intermediaries between large companies. Now, why do you put small intermediaries between large companies? That's to deflect attention off the trade, because everyone knows human psychology. The moment you see the world's largest trade finance banks or the world's largest trading houses, you automatically think this has got to be legit. This has got to be kosher. It's coming from this company. Not enough questions are being asked as to how the documents, how the BLs, how the warehouse receipts have got into the system in the first place. And that's where I think there might be a problem, because for an easy margin, documents could be passed through many different established companies, and they might not know any better. They might be implicitly or inadvertently assisting with a sham trade. Some other trends we tend to see is that it typically involves ports with very poor shipping procedures, and that's why a BL might not be able to be verified with the same company between different ports. The same shipping line, but between different ports might give you a different answer. With poor shipping procedures, BLs can be forged, customs documents can be tinkered with or manipulated, and that's where problems will arise. But the most important factor that leads to this sort of trades would be there is no central repository. There's no common database of which BLs are lodged, or which lenders can see what BLs have been pledged or are in play. And that's the point I raise about putting it on Accra and having it visible to the world. And this is the point of what many blockchain companies are chasing after, trying to digitalize trade finance to make it more secure. And I think it works as a concept. It works. I raise two observations about blockchain about the use of blockchain in this situation. Number one, blockchain is a bit like communism. It's only as good as it's only as good as far as the entire world needs to take part in it. If one country decides not to take part in it, it will fall apart. So similarly, blockchain works if every bank, every trader takes part in it. If you haven't got a large enough ecosystem for it, what you will have banks from exotic jurisdictions who are keen to take on trade finance, who are willing to take on the risk, who will not take part in blockchain. And as long as one bank is not in that ecosystem, mirror trades can be created. The second point I want to make about blockchain is that it is only as good as the information being provided to it. So once a fraudulent trade has been put into the system, it then gets legitimacy. And I raise this because, as I mentioned before, one of the ways of actually giving any phantom trade legitimacy is to pass it through a big trading company or a big trading bank. So likewise, blockchain can then become the new problem. I raise this point not to knock off blockchain. I hope it gains sufficient traction, and I hope it, even though it might put me out of a job, I hope it actually works to the benefit of all parties involved. How the issue I want to raise in this slide would be, how do you spot a double finance? And that's the question we could get asked all the time. And if I could share some, these are not concrete answers, but there's just some guidance I had over the years. And effectively, what you're looking for in a double finance, in a phantom trade or sham trade, is what I call the conduit trader. Now, who is the conduit trader? The conduit trader is someone who is just in it with no skin in the game. He's in it to just pass the documents through. Let's use it actually, he might not be accurate. The company, the trader, is probably not a product specialist. They probably trade scrap today, copper tomorrow, palm oil the next day, agri the next day as well, and then back to cotton or something. They're trading different goods at different times. They also don't know much about operations. Such traders, if you were to speak to them, whether you are a lender, whether you're an insurer, if you were to speak to that trader and say, how long does a voyage take between Africa and Asia? What sort of vessel do you need to move coal from Indonesia to India? They wouldn't know these answers because they're not in the business of operations. And that might indicate that what they actually are in is just a question of shuffling paper from one party to another. There might be 1-2-man operations set up in Singapore, Hong Kong, Dubai, or Geneva, large part really to access cheap financing. Another telltale sign is unrealistic margins. I think it's important. I know it's not our job, but it's important for people in the system, in trade finance, to know what margins are capable of being made. Because when you have unrealistic margins, then the question you have to ask yourself is this really a legitimate trade? And so I'll end this slide by saying one thing, which is, if I could give any guidance with the benefit of hindsight, it would be this: if the trade is too good to be true, it probably isn't. Let me move on quickly in the next 5 minutes to our last slide to deal with warehouse financing before we take some questions. Warehouse financing, much like the slide before, has its own issues. And in particular, I think the big difference with warehouse financing is that warehouse receipts in most jurisdictions, okay, let's say not say most jurisdictions, but in common law jurisdictions, in England, in Singapore, for example, warehouse receipts are not title documents. They are just receipts. They don't give a right to the title to the goods. You can't show up to they can't be negotiated. You can't show up to a warehouse and say, please give me the goods, here's the warehouse receipt, if your name isn't on it. So a warehouse receipt is a document that's used by borrowers to get financing, and that could be on a borrowing base level, that could be on an actual asset-specific loan as well. And how it works in this structure before us is this: a borrower borrows money from a bank. It then gets the goods. It places it in a warehouse, pending selling it to a buyer. It then pledges this warehouse receipt to the bank. Now, I stress the point that it pledges the warehouse receipt, and it is just a receipt in most cases that's being pledged. The key point about warehouse receipts is the dotted arrow that goes to where I've used the word attornment, the dotted arrow in blue. So blue represents movement of documents. Blue represents movement of security documents. So the attornment is quite key. And I raised this point again, the attornment is something that is done by the warehouse operator to the bank saying, I acknowledge you as the bank have got rights over these goods, and I'm returning it. I'm recognizing my responsibility, my obligation to you as the bank. And that creates a more secure pledge. That gives you, as a bank or a lender, a right of recourse to the warehouse operator direct. That was the missing point in the Mercuria case. Although it didn't turn squarely on that issue, one of the issues that were raised was that there was no attornment in that situation. Where there's attornment, the bank sits comfortably with a pledge with some security over there. But once again, from experience, what we've seen is that while the bank is holding on to the security, the goods have been sold, have been moved out of the warehouse, they have been pledged to another bank. Pretty much what's happened in Mercuria and Citibank. The goods have been pledged to various different banks while sat in the warehouse. The risk factors of a warehouse would be you're really relying on the warehouse operator. If the warehouse operator was to fraudulently create warehouse receipts or to forge warehouse receipts, there's very little you can do then. I think that's a major risk involved in that situation. Another major risk is the timing. Goods are set in a warehouse for a fairly long time. Now, if you think about it, on water, when goods are being moved from country to country on water, a voyage could take, I don't know, 3-4 months at best. That's the period of time which an unscrupulous trader can rotate the bills as many times as possible before it reaches its destination. Now, in a warehouse, goods might be there for months and months and months. And so that visibility over who last had ownership of the goods is a problem. Another point I want to raise is that while the banks are holding on to these pledge documents with comfort, what they might not know is that the value of the goods might go down. Cashew, for example, I always bring up cashew. Cashew might not go through the roof, might actually go down the drain in terms of pricing. And so the value of your security now has been compromised, and what you think you have isn't quite what you have. We've had pledges where we've asked the warehouse operator, and we've found the goods have been gone. And sometimes what we find is that the borrower seems to do a side deal with the warehouse operator. So the borrower tells the warehouse operator, don't worry, the goods are here, just release these goods to a third party. I will make sure my new set of goods will come in and replace it. We don't need to tell the bank anything. No one will know it's ever been gone in the first place. So sell it to this third party, and by tomorrow, new goods will come in. I'll indemnify you, warehouse operator, if need be. And that's where the problem lies. In all these dark rooms and side deals are being made between different parties, not informing the banks. And then when the banks finally know, their recourse isn't effective anymore, because their recourse against the warehouse operator might not be all that good. Against the borrower, typically is quite negligible. I believe I've come to the end of this session. I'm going to take some questions now from the audience, and let's just see if we can pull out the questions for a second. Okay. Let's start with a question on credit insurance and how credit insurance excludes fraud on trade policies. And so the question asked is this: insurers typically exclude fraud on trade credit policies. Presumably, a loss caused by a phantom trade would be excluded. In what ways then is the transaction risk passed on to the insurers? I think this is a good question. I think, yes, the insurance policies typically, I would say almost definitely would exclude fraud. And yet you'll be surprised, you would find stories, I know from the insurers in particular, that some insurers still say, well, if fraud is not mentioned in the policy, then you must cover fraud. I would stop to say, and I don't think any lawyer would actually say things so sweepingly, but I think it's safe to say that fraud will never be covered under an insurance policy. Now, yes, so fraud will be excluded, but where the contention will lie is this: it will lie with the disclosure of the risk undertaken. The insurers, in large part, will say one of two things. They would say, for example, in a circular trade, the insurers would say this is not a physical trade. A synthetic trade has been created. This hasn't been disclosed to me, and that has increased the risk. So that's where I think there's a gray area between the risk taken on by the banks and that being passed on to the insurers. And I raise this both to the banks and the insurers as well, because the banks, lenders need to be a bit cognizant that insurance policies are not guarantees. Despite what you might think of your Basel requirements, it's still not a guarantee. It's a passing of risk, and that risk is not a certainty. It is a maybe. The second question I have over here is the question on house BLs and ocean BLs. How do you tell if a BL is just a mere receipt or a bearer bill? A bearer bill meaning a negotiable instrument. This is a question that gives lawyers a lot of work, really. It's a question of construction on the document. What I would say is this: that a BL if I issue a BL today, would it be a BL? And the answer is no. And the answer is no because when you're constructing the document, you would say, I am not a carrier. I do not carry on the business of moving goods from point A to point B. Now, a freight forwarder, I think it's arguable to say that a freight forwarder is a carrier. So depending on the facts, a house BL might actually be a title document. Now, we just have to bear in mind that these BLs are a lot of people sign off on it without knowing what exactly they're doing. So I've seen BLs where they say the freight forwarder is signing off on behalf of the carrier, on behalf of the shipping line. And that doesn't seem to make sense to me because the freight forwarder is an agent of the seller, the person who's contracted with it, and not with the ocean liner. And language like that makes it quite confusing. So there's no one standard answer. But I think an endorsement saying goods have been shipped on board, yeah, I would say on balance, I think that's more akin to an actual BL. Sorry, an actual title of the document. Third question I have, and this is the last question I'll take for the day, is this: is house BLs common only to container cargo and not in dry bulk and liquid trade? I would hazard a guess and say yes. I'm not in the operations business, but I think in large part a lot of the house BLs we have seen involve container cargoes, and that seems to make sense because a freight forwarder typically has to aggregate different cargoes, put it into a container, and then issue a house BL for each good, and then get an ocean BL instead. So that seems to make sense to me, and that's where I would think we don't typically see house BLs for coal, for example, or for oil. Okay, so that's where we've come to. We've reached our 60 minutes, folks. I hope you found this session useful. I know it's been a very technical subject. I hope I've tried to make it as easy as possible. And the points that I've raised are themes that I hope parties or lenders or traders, insurers would remember throughout this process, because I think these are common themes and they can help prevent problems from happening down the road. On my parting note, I want to say one wish, and that is for everyone to keep safe. We are recording this in March 2020. The world as we know it is no longer the same. I know there's a lot of worry and a lot of anxiety across the world. Most people are watching from home. And my message is, I hope everyone is safe and this will pass and the world will come back to how it is normally. And we'll watch this in a year's time, perhaps, and you won't recognize or you won't remember the anxiety that you're going through in this moment. All the best. My best wishes and my prayers with everyone. Thank you. Bye-bye.